Welcome to Startup Taxes 101 with Stanford Angels and Entrepreneurs United. We're joined by speakers Tim Shapiro and Sangini Gwenka today. Our group unites the Stanford startup community and innovation centers beyond California with regular remote programs. Thrilled to have you join us. I'm Sheila Pruva, president of the group, managing partner of Primero Ventures, and a Stanford engineering alum. Since we're less than a month away from the tax deadline, we're delighted to welcome Sangini Gwenka from top accounting firm Frank Rimerman and Tim Shapiro, star tax partner from Cooley LLP. Today's format will start with speaker intros, followed by their discussion of key topics related to taxes. Speakers will touch on some of the questions submitted during registration, with upcoming announcements. I'll hand it over to Tim and Sangini now.
Thanks so much, Sheila, and thank you to Stanford Angels and Entrepreneurs United for having us to speak about tax issues with startups. So my name is Tim Shapiro, and I'm a partner in the tax group at Cooley LLP based in Palo Alto. For those of you that don't know Cooley, we're a large law firm that was founded about 100 years ago in San Francisco. One of our core businesses is advising technology and life sciences companies at every stage of their life cycle, from early stage startups up through public companies. And my practice in particular focuses on advising companies with federal tax issues with their transactions. So I spend a good deal of time on mergers and acquisitions and debt and equity offerings, because tax is usually a critical component of those deals. And I also devote a significant portion of my practice to advising startup companies on helping to navigate tax issues for founders and early stage investors. And this component of my practice is going to be the focus of our presentation today. So I'll pass the torch to Sangini to talk about her practice and Frank Rimerman.
Thank you, Tim, and thank you, Sheila and Stanford, for having me over here. I'm Sangini Gwenka. I'm a tax partner at Frank Rimerman. Frank Rimerman is an accounting CPA firm. It started about 70 years ago here in the Silicon Valley. I am based out of the Palo Alto office, and we have offices in Palo Alto, San Francisco, San Jose, but we have people all around the country as well. And because we started in the Silicon Valley, our firm's core business is startup companies, startup founders, venture capitalists, and all of the things that goes on in the Bay Area. I'm in the tax practice of Frank Rimerman, and my main practice deals with working with ultra high net worth individuals who are likely founders of companies or venture capitalists, and helping them with their tax planning, tax compliance, and wealth transfer cases. A lot of my practice evolves around things we are going to talk today, which involves what are all the things that a startup founder may want to do, or a new venture fund partner may want to do as they start their fund. I'll hand it over to Tim to start with the presentation.
Great, thank you. Yeah, so before we begin, so tax is one of those areas where usually there's several different advisors working on the same transaction. So there typically will be tax lawyers like me negotiating the documents and drafting the agreements to memorialize what is going to happen. And in parallel, there are going to be tax accountants like Sangini that are preparing the tax returns that are going to reflect the effects of the transaction. So we typically collaborate as much as we can to ensure that everyone's on the same page and all of the documents reflect the kind of intended tax consequence of a transaction. And today we're going to be discussing some of those startup transactions kind of from both the legal and accounting perspective. So you get kind of a flavor of the considerations that both of us think about for these deals. So before we begin, a few reminders. So this presentation is intended to provide a general, non-exhaustive overview of tax considerations for startup companies. The tax rules we will be discussing are complex and subject to change, and there are several exceptions to each of these rules, and we won't be discussing the specifics of each exception. The tax consequences of any transaction or scenario will ultimately depend on its particular facts and circumstances, and the presentation does not constitute tax, legal, accounting, investment, or financial advice to you in your specific situation. We'd recommend that you consult your personal advisors for such advice. And as a reminder, Cooley LLP, Frank Rimerman and Company LLP, Stanford University, Stanford Alumni Association, and Stanford Angels and Entrepreneurs United are not providing tax, legal, accounting, financial, or investment advice. So with that out of the way, this is a list of the topics that we're going to discuss on today's presentation. So we'll start with an overview of some of the main tax rates that a startup and its founders and investors will encounter. And then we'll talk about the different entities that startups can organize as to operate their business and the tax implications there. Then we'll talk about 83B elections and qualified small business stock and get into what each of those means in more detail. We'll talk about some of the tax-related issues that come up when a startup is being acquired in an M&A transaction. We'll talk about some recent changes in how research and development expenses are dealt with for tax purposes. And we'll close with some high-level thoughts and tax considerations to keep in mind for US people investing in foreign companies. With that, I'll hand it over to Sangini to start with an overview of the tax rates.
Start with the overview of tax rates. And at the end of the slide, all of you will get a better understanding of why it is very important for both the lawyers and the accountants to be together as you go through an exit or a merger that may be there. So very, very big picture. For federal income tax purposes, for your ordinary income or compensation or even short-term capital gains, the tax rate is 37%. For long-term capital gains, meaning if you've held any investment for more than 1 year and then you've sold it, the capital gain rate is 20%. And on any investment income, whether it be interest, dividend, or capital gains, there is a Medicare tax of 3.8%. So that's the very basic tax rates. And again, this is the highest tax slab for the tax rates. If you're in a lower tax slab, you could pay a lower tax rate. And there are other issues that do come into play in taxes, where if you go into AMT or if you have qualified small business stock, and all of these we'll discuss further in our slides. So the tax rate is really what I talked about is for individuals. For corporations, which are taxed as C corporations, the corporate federal tax rate is 21%. In addition to these rates, if one is an employee of a company, there are payroll taxes that are paid. There's in the payroll taxes, there's Social Security and Medicare. And as a founder of the company, it may be important for you to know that when you take payroll as a founder, the company is paying the employer tax rate for payroll taxes, and the employee is paying the employee tax rate. So when budgeting, that can land up being, a double of payroll taxes that one would need to pay for companies. So that's only the federal tax rates. Now, in California, I wanted to share for California individuals, the California individual tax rate is 13.3%, and the California corporate tax rate is 8.84%. When we work with clients, we typically talk a lot about what is the effective tax rate that you will pay on a particular exit or on a particular compensation structure. And we try very hard to see how one could fall under a capital gain rate versus an ordinary income rate. And there is a lot of planning that goes around there. So if you are a California resident owning more than $1 million a year, your long-term capital gain rate, effective capital gain rate is 37.1% versus your ordinary income, which includes your compensation income, is 54.1%. So there's a pretty good differential between the tax rates. And typically where this comes into play is when you are getting an exit, how is your exit really structured? If it is like a stock for stock deal, you really don't want to pay any tax if you're not going to get any cash. And that's an important component. And therefore, for our clients, it's important that both the attorneys and the accountants are reading that agreement much before it's signed. And if there is a cash component, you want to try to see that you fall under the capital gain rate situation and that cash doesn't count as compensation income to you.
Yeah, this distinction between long-term capital gains versus ordinary compensation income, that comes up in lots of different places in the startup context. A founder typically holds a significant component of the stock of their startup, but they're also an employee of that startup. So they wear two hats. And so there's often a question, well, whether is a payment to that founder compensation in their capacity as an employee, where it would be subject to ordinary income plus the payroll taxes on top of that? Or is it a payment in respect of their status as a stockholder, where potentially it could be subject to the lower long-term capital gains rate. So this comes up kind of in different permutations at different points in time. And we'll talk about some of them, but it's kind of a dynamic to keep in mind. So next, we'll talk about choice of entity. So when a founder is deciding to start a new business venture, one of the first questions is what type of entity should they organize as? A C corporation is the most common type of entity that startups organize as. And it's well understood and relatively inexpensive to operate because it's the simplest. A C corporation allows for familiar employee incentive structures. So a C corporation can issue their employees stock options. So if you've received or if you've heard of ISOs and NSOs, those are the types of equity incentives that a C corporation can issue, and employees understand what they're getting there. The C corporation structure also may be required to seek investment from institutional investors like venture capital funds. So venture capital funds often prefer the C corporation structure because it's common and well understood, but there's also a tax reason. So oftentimes the venture capital fund will itself have either foreign or tax exempt investors, and they generally are sensitive to the types of income that the venture capital fund is generating. And if the VC fund invested in an entity other than a C corporation, it could generate income that the foreign investors or the tax exempts are looking to avoid. Those types of income go by the acronyms ECI and UBTI, and we won't get into the kind of nuances of what that means, but just keep in mind that kind of if you're organizing your startup to seek venture capital funding, the smoothest path to doing that is usually organizing as a C corporation. One of the potential downsides to organizing as a C corporation is the possibility for double taxation. So as Sangini mentioned before, the corporation itself pays income tax on its income. And then if the remainder after paying that corporate income tax is distributed up to the shareholders, they may be taxed again on that as a dividend. And so if you are a startup that is in a kind of a profitable position and you're generating cash and paying tax on it, and you're paying so much and you're getting so much cash that you need to send some of it out to your shareholders, the two levels of tax there may be higher than if you'd organized as an entity that's just subject to one level of tax.
A lot of times people have asked me like, oh, under the Trump law, when the Trump law came into play, he really reduced the corporate tax rate, right? It used to be 35%, it came down to 21%. So there are times where founders have asked me like, hey, am I just better off being a C Corp? You are, provided you are not highly profitable. So sometimes it may not be a technology company. It could be where clients want to form a real estate company where, they are expecting to be profitable, or they want to form an investment company. In those cases, you want to be careful if you're expecting to be very profitable from year 1 or year 2 onwards, and the intention is not an exit, but just to have a lifestyle entity, then you may want to consider other forms of entities other than C Corp.
Exactly, yeah. So the first alternative that you may consider is forming your business as an S corporation. So an S corporation generally allows for pass-through taxation, meaning the income that's generated by the S corporation isn't subject to corporate level tax, but flows up to the S corporation shareholders and is taxed to them directly. There's an asterisk on this bullet though, because some states impose a corporate level tax on their S corporations. So California, for example, has a 1.5% tax on an S corporation's net income. So it's not pure pass-through taxation. One thing that I often caution my clients about when they're considering forming as an S corporation is that the S corporation structure has very rigid and restrictive requirements. And if the S corporation violates those at any point in time, it automatically converts to a C corporation. And sometimes you can violate those restrictions unintentionally and be a C corporation even while you think that you are still an S corporation. So the main requirements are that the S corporation can only have one class of stock. It can have no more than 100 shareholders, and they must all be domestic. And it can't have any entity shareholders. So if you had a single class of stock and you're going along as an S corporation and you decide to issue a SAFE, which is generally viewed as stock for tax purposes, you have violated the single class of stock requirement and you now are a C corporation, even if you don't know it. So there's kind of a lot of potentials for foot faults with the S corporation structure, and you just need to watch out to make sure you're following the requirements there.
And typically, Tim, a venture fund would not be able to invest in an S corp, right? Because
exactly.
One is they are an entity, and even if they were not an entity, it was a single investor, they may want some type of preferred return. So even that having that preferred return makes it kind of a separate class of stock, and therefore they would want you to change it to something else other than an S corporation.
Yeah, exactly. So we often see situations where a startup has initially formed as an S corporation and then decides to convert to a C corporation when they take in venture capital financing. One of the potential benefits of the S corporation structure is that they can deliver tax benefits to a buyer in an M&A transaction. It's referred to as a basis step up, and it results in deductions that the buyer can use going forward to offset its income taxes. And so sometimes a buyer would be willing to pay more to acquire an S corporation because they can get that tax benefit from the basis step up. The final category of entities that startups can choose to organize as is an LLC or a partnership. These entities generally also are eligible for pass-through taxation, so there's not the possibility of 2 layers of tax. An LLC or a partnership is a very flexible structure, so it can accommodate very complicated economic deals among the equity holders. But as one of the kind of potential costs of that flexibility is that it also has very complicated accounting and tax filing obligations going forward. So for example, if you are a member of an LLC that's operating in several states, you generally need to file tax returns in each one of those states because you're treated as having income in all of those states. So it can get complicated to kind of administer the LLC or the partnership structure. Another area of with a similar flavor is that the LLC incentive equity that's issued to kind of employees of the business is generally in the form of something called a profits interest. Those are generally more tax advantaged than a stock option would be in a C corporation, but they're also significantly more complicated. So sometimes it's difficult to explain to employees what exactly their interest in the business is when they hold a profits interest. Like the S corporation, an LLC or a partnership can also deliver a basis step up in an M&A transaction. So that can sometimes be a benefit. And LLCs and partnerships can take in investment from institutional investors, but it generally requires some structuring to do it to avoid generating the ECI and UBTI that those VC funds are sensitive to. So with most things with an LLC or partnership, it's doable, but it's more complicated than the C corporation structure.
And I think I'll just add one more thing where we are going to talk about qualified small business stock later. But in order to get certain tax benefits of owning selling a qualified small business stock company, you really need to be a C corporation. So if you did form an LLC to start off with, typically a founder would start off with an LLC where they are not really looking for outside investments. They are starting a company. They have their own losses. They want to take the benefit of those losses, right? But as soon as a company knows that, okay, now I really need to get venture funding, that's the time that we see it typically get converted to a C Corp, because the qualified small business stock exclusion, which we'll talk about later, is very, very beneficial to the founders and to venture capitalists. And it's one of those tax provisions which is still there, and not, in spite of it being attacked many, many times by Congress, nothing has changed there. So we do feel it's a great benefit that's there. And that benefit would not be available if you sold an LLC interest versus selling your C Corp share.
So switching gears a little bit, we're going to talk about 83B elections now. So one of the attendees had asked about whether 83B elections are necessary. And so we wanted to just talk about kind of the pros and cons of an 83B election. You may
Yes,
have
Tim, there is
encountered.
one question that has come up, and it's an easy one, so I would like to just answer that. Does a California LLC need to pay 800 annual during its first calendar year? And I believe both LLCs and C corporations have a first year exemption to pay $800. But beyond that, yes, you have to pay $800, whether you're a C corporation or an LLC in California. It's basically a cost of doing business. And in an LLC, there is something more, which is called gross receipts fee, where as you have more income in the LLC, not net income, gross income, you have franchise fee that you need to pay, which goes as much as $11,790. So, I just wanted to answer that.
83B elections. So 83B elections arise in the context of restricted stock. You may have received restricted stock in a startup if you were a founder or an early employee. And restricted stock is generally stock that's issued to early service providers that requires them to stay with the startup company for a specified period of time, usually 4 or 5 years, until the shares fully vest. And if the recipient leaves the company during that period, they forfeit the unvested shares back to the company. When someone receives restricted stock, they can make an election under Section 83B of the tax code, which changes the way the restricted stock is taxed. The takeaway here is that it generally makes sense to make the 83B election because the tax rules under 83B are simpler and usually more beneficial to the holder than the default rules that would apply if they don't make the election. But there are some trade-offs. So we'll talk through the default regime for taxing restricted stock first, and then I'll tell you how the 83B election changes that. So under the default rules, the recipient of the restricted stock is taxed on it as it vests based on the value of those shares on each date that they vest. So a founder isn't taxed on the unvested restricted stock when he receives it up front, but he recognizes taxable income that's treated as compensation on each date that those shares vest in the future. And so this would seem like a benefit. You're delaying the tax event for the founder, but it actually usually is detrimental because if the company is doing well and increasing in value over that 4 or 5 year period, those shares may be worth a lot more in year 4 when they're vesting than they would have been right when the startup was founded and it didn't have kind of a proven product yet or anything. And I mentioned the value that the founder recognizes as income on those vesting dates, that's compensation. And so if the founder is an employee, the company would have an obligation to withhold payroll taxes on that amount on each vesting date. So the default regime results in tax over time, usually every month as the shares vest, and the company needs to come up with a mechanism to pay the payroll taxes on those vesting dates, even though no cash is going to the shareholder that it can be withheld from.
And
so,
then I just want to add here that it does also cause complexity for valuing the shares, right? Because when it's vesting, the company is not going to do a 409A every month. But if you did report one income for 1 month and 3 months later you sold your company for 10x or 20x what you reported, again, that could cause more compensation issues. Therefore, typically we see our founders make the 83B election.
And sometimes the company requires it because it simplifies everything. So let's talk about kind of the regime that you are in if you make the 83B election. So instead of being taxed as the shares vest, if you've made a valid 83B election on those restricted shares, you're taxed on the entire value of that restricted share issuance when you receive them up front, based on the value when you receive them. So it accelerates the founder's tax event to the earlier date, but also probably the stock is worth less at that earlier date. The main thing to keep in mind with the 83B election is that there's a very strict 30-day deadline to make it after you receive the shares. So oftentimes, the company is very focused on making sure the founders file the appropriate paperwork with the IRS to make the 83B election, and that they get sufficient documentation in order to prove to anyone in the future that they did make a valid 83B election on those restricted shares. So then the company's life is simpler because there's only one compensation event that they have to withhold payroll taxes from on that initial restricted stock issuance date rather than over time going forward. There's some other ancillary benefits to filing the 83B election as well. So if you file the 83B election, the founder's holding period starts on the date that he receives the shares. And so the holding period is relevant for several reasons. One, for the 1-year holding period requirement for long-term capital gains, and also for a similar 5-year holding period for QSBS benefits that we'll talk about in the next slide. And if the 83B election isn't made, the holding period starts on those vesting dates in the future, so later in time. So as you can see, there are trade-offs between making or not making the 83B election, but the vast majority of the practice in Silicon Valley is to make the election whenever possible. And sometimes there are situations where it's not entirely clear whether the specific scenario requires a new 83B election. This sometimes comes up when companies are exchanging stock for a different stock subject to vesting. And often in those situations, the recipient will make something called a protective 83B election, which essentially says to the IRS, I'm not sure whether an 83B election is required in this circumstance, but to avoid any doubt, I'm making one just in case. So it kind of underscores the dynamic for 83B. So now we'll shift gears and Sangini will talk about QSBS benefits.
So qualified small business stock, right? As I said, it is one of the best benefits available to founders and venture funds. I'm going to try to make it simple, but it's a real good, great benefit that right now exists for small startup companies. Basically, the rule goes as if you invested in a startup company or as a founder, when you got your shares in a startup company and you held it for 5 years and you sold the company after 5 years, then the first 10 million of gain you can exclude from federal income taxes. California doesn't comply to that, but other states do. But up to $10 million you could exclude from gain, which is a pretty good amount. Like if I look at the federal effective tax rate, that's 23.8%. So if you had an exit worth $11 million, you would really pay tax only on $1 million and you would save $2.3 million of taxes just because you can claim this qualified small business stock exclusion. And the other rule is it's greater of 10 million or 10 times your cost basis. So say if a venture capitalist invested $5 million in your company at the time when the company does qualify as a QSBS company, then when there is an exit, they could exclude up to 50 million of gain from being taxed. And this is per stock. So it's not your overall gain from all your shares. It's per stock. You can exclude either 10 million or 10 times basis. Now, most of our clients want to get there, right? Because this is such a great benefit and there's no reason not to claim this exclusion. So it's very, very important that you meet all the criteria to claim this exclusion. Many years ago, this was heavily audited. Recently, I have seen some audits, not a lot, but companies have gotten pretty good at getting good backup information, where in the case of an audit, once we provide the information, they relatively allow it. So the key requirements are your stock should be an original issuance stock, meaning that the company should have issued you shares. You couldn't have shares which you acquired from your previous founder. That couldn't work. So it needs to be issued by the company. You need to own shares of a C corporation. And hold it for 5 years. So that's another test.
Let me jump in here with one fact pattern that I often see. So oftentimes with a startup, they're doing their first round of outside financing, either seed VC firms or angels are coming in. And the outside investors are purchasing preferred stock from the corporation, but they also want to give some liquidity to the founders. And so they agree to purchase some amount of the founders' common stock directly from them. Because they've purchased that stock from the founder rather than from the company itself, it loses its ability to qualify for QSBS benefits in the investor's hands. So sometimes there's a lot of structuring and scrutinizing to see whether there's a way to structure the investment to achieve the effect of giving some liquidity to the founders while still preserving as much of the QSBS benefit for the new investors as possible. So just a fact pattern to watch out for.
And I'll add to that fact pattern where I see founders burnt a lot. So the VCs are very smart, right? They know how to structure this well. So they may sometimes structure it as a redemption where the founder is, basically the company is buying over the founder shares. The issue there is if the founder then is reissued shares within 2 years, those new shares don't qualify for QSBS. So my advice to all the founders is before you get some form of exit because of a new funding round that you guys have had in your company, make sure it's structured in a way that your current shares and future shares, if the company qualifies, they qualify as QSBS shares. I think the next test is a 50 million gross asset limitation test. This means that your company's assets need to be under $50 million when you acquire the shares. Keep in mind, this is the gross assets of the company, not the value of the company. A lot of times founders are very often mistaken where a VC could come and put in $20 million, valuing the company at $60 million. That doesn't disqualify the shares as QSBS shares, because when the venture fund is putting in $20 million, maybe there's $2-3 million of cash sitting in there and some assets, but the total assets of the company have not grown above 50 million. And it's not the value, but it's the 50 million gross asset test. It's basically assets on the books of the company. And there are some adjustments, but that's about it that you need to pay attention to. And the other requirement is active business requirement. This is key. And a lot of companies have disqualified because they don't meet this requirement. Active business requirement means that 80% of your assets are used in the active trade or business of the company, meaning that the company is not having investments, company is not investing in other things. It's really doing a trade or business. And there are certain types of industries that don't qualify, like banking industry doesn't qualify. I believe real estate industry doesn't qualify. You really have to be in this technology type industry to qualify. I remember when these fintech companies got their IPOs, we had to go to the law firms and get an opinion on them to really see if they qualify as a finance company or do they qualify as a tech company to claim this QSBS exclusion. And then the last requirement is limitation on redemptions, as I talked about earlier. This is a more technical rule, and I don't want to get into too much detail here, but anytime the company is doing redemption of shares, likely there is some limitation on those shares or future shares that are issued on whether they qualify as QSBS shares or not. One other key thing to note is if a venture fund purchase qualified small business stock, they can pass through that benefit to the partners of the venture funds. And therefore, most venture capitalists can claim this exclusion. And this is one of the primary benefit for venture capitalists, because a venture fund invests in 10, 20, 30 companies, right? So if it's a seed or a Series A type venture fund, they are likely to be able to claim a lot of qualified small business stock exclusions on their exits. One other key one to remember is if you take your qualified small business stock and contribute that stock to a partnership, then you those shares disqualify from being called QSBS. This is just a tax rule, so there's not much you can do around it.
Yeah,
but,
That's just a common trap. And so if you're a founder and you're thinking, well, we'll contribute our shares to an LLC holdco that will hold all of the founder's stock, that's kind of a common QSBS gotcha almost. Like there's just a statement that says that you can't contribute it to an LLC or a partnership. So keep that in mind. We'll talk about just a sample of the type of tax issues that come up when a startup is getting acquired by another company in an M&A transaction. So I do a lot of work with M&A deals, and the kind of particular tax diligence issues that come up, they vary by company, as you can imagine. But just to kind of set the framework, when a buyer is buying a startup, they're going to do diligence to basically understand the startup's tax history and try to understand whether there are any kind of past tax liabilities that the buyer may be inheriting by buying the startup business. One of the areas that often raises issues in the tax diligence process is on the startup sales tax collection practices. So every state has its own rules about what activities are subject to that state's sales tax. And for startups that are providing, say, like a cloud service or some sort of digital service where they're not actually in a state, but they're providing services to that state's residents, the rules for what is subject to sales tax vary significantly from state to state. And so I often see companies kind of have to confront whether they've been collecting and paying sales tax where they should be on an exit event. And so that's one area where kind of as you start generating revenue from your activities as a startup, you may want to work with a tax accountant to just make sure you're kind of on top of the sales tax compliance piece, because it's difficult to kind of have to deal with that at the time that you're trying to also negotiate a merger agreement for the sale of your company. Another area that often raises issues are on the validity of 83B elections. So like we said before, if a company issued restricted stock, but there wasn't an 83B election made on it, the company should be paying payroll taxes on every vesting date for those shares. And so the buyer will want to kind of make sure 83B elections have been made for the restricted stock. And typically will ask for kind of a date stamped return receipt from kind of the founder mailing the 83B election to the IRS. Another issue that comes up is whether the company has been properly classifying its service providers as employees versus independent contractors. So amounts that you pay to independent contractors, you generally don't have to take payroll taxes out of, but you do for employees. And so a buyer could be concerned that the startup it's considering whether to acquire was treating people as independent contractors and not paying payroll tax when it really should have been treating them as employees and deducting the payroll and withholding taxes. Another area that's been coming up a lot recently is on companies claiming benefits under the various CARES Act tax benefit regimes. So in particular, during COVID, Congress passed a bunch of rescue provisions to encourage companies to keep their workers on the payroll, even if their business was suspended. And so one of these was called the Employee Retention Credit Program, and it allowed employers a fairly significant tax refund of their payroll taxes if their business was subject to a government shutdown order or they experienced a significant decline in their gross receipts. And so companies have been claiming the employee retention credit even when maybe they didn't, even when they weren't eligible for it because they didn't meet the decline in gross receipts. And the IRS has flagged that this is an area that they're focusing on going forward. So they're planning to do significant audit work on employee retention credit claims. And so I've seen buyers look very closely at startups' documentation to establish that they were eligible for employee retention credits that they've claimed in the past. And finally, for an S corporation, I mentioned that the S corporation can deliver a basis step up to the buyer, and the buyer views that as a benefit going forward. So a buyer often will be scrutinizing the S corporation's history to make sure they haven't tripped any of the rules that would have automatically caused them to be a C corporation. So for an S corporation on exit, kind of proving that they are a valid S corporation is one of the diligence exercises.
And Tim, you bring up great points. And what I would like our listeners to know is your intention of doing the startup is to get this exit, right? So you may want to engage with an attorney or an accounting firm well in advance before your exit, because when someone else is buying you, they are going to do their due diligence and actually point out the smallest of things so that they can get a better deal, right? and and you being well prepared helps you get the best value for your company, and you don't want these small things to impact the value for your company. So our recommendation is you do engage with an accounting and a law firm few years, I would say, before you're going to go get an exit, if not from the start.
Totally agree. Okay, so we'll talk about Section 174 now.
I talk about good and bad in this presentation. So, just as how we talked about qualified small business stock and that being the best thing for founders, this code section 174, this is a new rule that came out, or a rule that's disallowed going forward. So maybe I can start with the law before 2022 was that if you're a company and you are, you're a startup company, you are really building your product and you're doing a lot of research and development. You're hiring engineers, you're hiring other people to really build your product. That expense was deductible as corporate expenses on your tax return. So we would typically see companies with huge losses in the first few years. Even if there was income, the expenses far exceeded the income. Now, from 2022 onwards, basically the government says that if you have research and development expenses, meaning expenses that is not directly related to your income for that current year, then those expenses need to be capitalized and amortized over 5 years. So let me give you an example. In your company, you had 2 million of revenue and you had 6 million of expenses. Out of that 6 million, 5 million is really to engineers, paying payroll, building your product, building new things that's coming. What this law would tell you is you actually have taxable income of 1 million, because that $5 million you have to capitalize and amortize over 5 years. But your taxable income is 2 million of revenue and 1 million of sales, marketing, and other administrative expense. And yes, you'll get some portion of the amortization. So this has caught a lot of our founders off guard as we are working on their tax returns. And this law was passed back in 2017, but it wasn't mandated. And it's really after 2022. Till 2022, it allowed for immediate deduction, but from 2022 onwards, that immediate deduction law expired and it did not get renewed. So it's really not beneficial, especially for the first 2-3 years. Now, I'll share that for companies that basically hire employees outside the country to do research and development, that amortization is really over 15 years. So that is really a long time. So you're not getting the benefit of deducting the cost that you incur for paying engineers outside the country. I think it's important to understand this law and really understand the tax implication. If your company is not having material revenue, probably doesn't matter to you as much. But if you are a company that is generating revenue or expecting to generate revenue pretty soon, you may want to look into this to see, how you are characterizing the expenses, what is really R&D versus what is not. In addition to this, there has always been a credit that is available, which is called research and development credit. So if you do research and development within the United States, then there is a tax credit that the government provides you against your taxable income. So that research and development credit will definitely help the company as against your profit and your tax liability. But I will say that the R&D credit claimed on the return is heavily, heavily audited. So we typically, if our if the credits claimed are more than $30,000-$40,000, we typically have our clients go and get a study done to confirm that that credit is valid. Because in the event it's audited, you can just provide that report saying that it's a valid credit.
Okay, and we are going to close out with a couple thoughts on outbound investment. So the tax rules here are very, very complicated, and this could be its own multi-hour presentation on the passive foreign investment company and controlled foreign corporation regimes. These are two sets of tax rules that apply if you're a US person that is purchasing stock of a foreign entity. So that foreign entity could be a passive foreign investment company, referred to as a PFIC. It would be a PFIC generally if more than 75% of its income is passive, or at least 50% of its assets are treated as held for passive income in any year. And so this often trips up early stage foreign companies that have a lot of cash relative to business assets. The other regime is you could be investing in a controlled foreign corporation, or a CFC, which is a foreign company for which more than 50% by either vote or value of the stockholders are US shareholders. And in either case, if you hold stock of a PFIC or a CFC, the tax rules could cause you to have to recognize income of that foreign corporation on an annual basis on your tax return, regardless of whether the foreign corporation has distributed any cash to you. And they also could result in tax if you sell your PFIC or CFC stock at rates that are higher than the rates that would apply for the sale of stock of a US company. I think that key point to keep in mind before you invest in a foreign company is just to seek some professional tax advice on that. There's several elections that you can make that modify the way kind of the PFIC rules or the CFC rules would apply to you. And there are also several tax filing obligations that you need to make with respect to cross-border investments. So it's very recommended that you kind of loop in someone to just kind of make sure you're thinking about all the right things and asking all the right questions before you make an investment in a foreign company. And so with that, I think we'll hand it back to Sheila for concluding remarks.
Awesome. Thanks very much, Tim and Sangini, for the excellent coverage of so many nuances that go into tax considerations for founders and investors. And as you mentioned, please consult an expert before endeavoring into these areas. Thanks again to both of you for taking time out of your particularly stressful schedule. We really appreciate it, and we can't thank you enough for your contribution and insights.
Well, thank you. I was happy to speak on it.